In this edition, we're going to talk about the RBA, we're going to talk about Australian economic data, and finally, we're going to touch on the Chinese economic slowdown. So hi there to everyone out there. It is the Traders Circle weekly market update. Today is Tuesday, the 5th of September, 2023, and before I begin, you do need to be aware that what I say is general advice only. So it doesn't consider your personal financial circumstances, and you have to decide if it's appropriate for you. RBA. So today we had the RBA meeting for September, and it was the last of Philip Lowe's meetings as governor. So he will be stepping back, and the assistant governor will be stepping up. Michelle will be taking the reins and leading the RBA from here on out. Now, much has been made in the media about this change, but really, the board is still the same people who are there already, so I'm not sure how much of a change it will be. The statement today really didn't tell us much. We obviously kept rates unchanged at 4.1%, and the statement may as well have been copy and pasted from last month's statement. There was really little change in the statement that'll give us an indication about the likelihood of rate rises moving forwards. They held on to the language that further tightening may be necessary in response to inflationary data or whatnot. But that's been there for the last several, obviously. So yeah, little indication of what their future outlook looks like. To me, it indicates that the RBA board wants to wait and see how data progresses, see how things pan out from here, rather than semi-committing to any future action. Now, data has started to slow down, but Australian CPI does remain persistently sticky. So the latest CPI growth data, the monthly indicator, was at 4.9%. That is coming down. It is starting to come off its very high levels, but it's still well above the 3% upper bound of the target range. And if anything, any indications that we can take from overseas is that maybe inflation is becoming a bit sticky there as well. So US CPI did tick up a little bit last month. The third-party inflation indicators, shout out to Trueflation, they're starting to tick up a bit. Oil prices have pushed back up a bit. You may be noticing that at the Bowser, and indeed, last night they closed at their highest level since November 2022. So with rising oil prices and inflation overseas, inflation here in Australia is yet to be dealt with. Our Australian dollar as well is quite weak at the moment, has been heading lower, and that worsens imported inflation as well. So a little bit surprising the RBA didn't change the statement. I thought Philip Lowe might want to go out with a bit more than a whimper, but that wasn't the case. Now, they did say they're going to keep looking at the economic data, and the data is, in general, it is starting to weaken a bit. So today we had the current account surplus. That was smaller than expected. I think the ABS talked about weakening commodity revenues in the second quarter. They said that was due to declining commodities prices. Commodities prices in general have ticked back up a little bit this quarter, but that's just one additional data point to look at. We will also get Australian second quarter GDP released tomorrow. That'll be very, very important in the interest rate inflation balancing act that investors are playing at the moment. I think we will see the probabilities shift on that report. Growth is expected to continue to slow, but it's still at a fairly high level. Overall, we're actually in a much better position than much of the Western world. Parts of Europe are in recession, yet they've still got mega inflation problems. So bits of stagflation in Europe perhaps. US is actually doing quite strong as well at the moment. But their inflation is remaining fairly sticky, and they did see perhaps a slightly weaker than expected jobs report last week. So at the moment, it's very much a data-driven market, very much an economic data-driven market, and it's not always what we want as traders and investors. We'd love to see stocks running their own race, trading their own trends, doing their own thing, but instead a lot of the market is being driven by what's going on in the economic data essentially, and it's often counterintuitive. So at the moment, any positive data that comes out is likely to be seen as a negative reading for the market. If unemployment's super low, our market's likely to fall. And the reason for that is any positive data might signal further inflationary pressure. Similarly, if we see data weaken, our market's likely to love that as it prices in less interest rate rises moving forwards. So data is what's driving markets at the moment. It's very important. Make sure you check the calendars and see what's coming up in the months ahead. A very important read will come next week, next Tuesday, with US CPI. CPI is an analog for inflation, and this is going to be the big one for global markets, really. Everyone will follow the US lead. If CPI is stronger than expected, we could expect to see selling and vice versa. There are indications that US CPI has started to tick up a little bit from the 3% low it hit a couple of months ago. So we do want to be watching that reading closely. Somewhere where data is fairly weak and continuing to weaken is in China. So today we saw the Caixin Services PMI that was lower than expected. We've seen weaker than expected manufacturing PMI recently, industrial production. Their unemployment data was not great. They've stopped reporting on youth unemployment because it looks not great for the country. Overall, there's definitely a slowdown in China. Part of one of the most important parts of their economy is the property development sector. The property sector is a quarter of the Chinese economy, and over the past sort of decade or so, the stimulus measures that the Chinese government has taken have very much inflated that property sector. Individuals have been encouraged to invest in property. Companies have been encouraged to develop property. The problem this time around is there's massive debt issues in that sector, and the Chinese government can't pull those traditional stimulus levers because it might worsen the issues in the property sector. So far it's been a pretty piecemeal stimulus response to the Chinese economic slowdown, and that's not really enthusing global investors with confidence. So we've seen a few measures announced recently. They've cut some lending rates. They've announced some support for steel smelters and a few other factors, but overall, there's still a lot of uncertainty around the Chinese economy. A lot of investors are hoping and waiting for more from the Chinese government in the form of stimulus, because otherwise, a lot of very large companies are on the brink. A lot of investors are, facing losses on their property investments. A lot of individuals, a lot of homeowners are facing huge hits to their household wealth, potentially, if there is a property crisis in China. And so this is something that we do want to watch very, very closely. It's a huge export partner for Australia, and it is very important to the largest stocks on our market. So let's quickly have a look at the charts for this week, guys. We'll start with the US market. This is the S&P 500, the most broad-based of the US indices. It had quite a good week last week. It pushed back up to the resistance around, let's say, 45.25, but it did hold that resistance on Thursday and Friday. So that upwards move may be losing a bit of steam over the last couple of days. US futures are currently flat at the moment, so it's not really giving us much of an indication of whether that level will hold, whether they'll fall from here or whether they'll rise through it. Should they show a bearish bar, we'd be looking for a move back to 44.50, and then if that breaks, to the recent lows around 43.50. If they can close above that level, that 45.25 level, we would expect a move back to the yearly high at 4,600. Overall, US shares are extremely expensive on a price to earnings basis, and especially when you consider the current level of yield on government debt. US shares extremely expensive by historical metrics, and that does give investors a little bit of cause for concern as we move into the final quarter of the year. Looking at our own market, we've also enjoyed quite a strong push up over the past week, and we've also found a bit of resistance over the past few days at perhaps 73.15 index points. We stalled at this level today, but we didn't really sort of fall from it. Initially, we were quite a bit lower. In fact, we showed perhaps a bearish signal at one point, but we did rally right back to close on that level. Should we see further gains from here, there's some resistance not far away at 73.60, while if we see renewed selling, we close off this level, we could see a pullback to 7,200. Overall, the technicals aren't super clear because, like I said, it's a very data-driven market. The market seems to be waiting for each and every new piece of data that comes out. Each piece of data could completely disrupt these technicals, so we do want to wait for nice, clear trends to establish. We do want to wait for nice, clear signals, and we do want to check the calendars and make sure there's nothing that might interfere with our trades. So that's it for this week, guys. Hopefully you enjoyed. If you did, make sure you subscribe. It really helps our channel out a lot. And I'll see you guys in the next one. Bye for now.